the early 2000s, while Wall Street cheered a booming housing market, one man was quietly reading the fine print, literally. Michael Burry, a former neurologist turned hedge fund manager, spent his nights poring over mortgage bond documents nobody else bothered to examine. And what he found was terrifying. Billions of dollars in subprime loans handed out to borrowers who could never pay them back. Loans that were being bundled, stamped AAA, and sold as if they were safer than cash. While banks, rating agencies, and investors celebrated record profits, Burry saw a slow moving catastrophe. So he made a bet almost no one had ever heard of: credit default swaps, essentially insurance against those mortgages collapsing. His investors thought he was crazy. Banks laughed as they took his money, and for years he looked painfully wrong, until he wasn't. By 2007, the very foundations of the financial system cracked. Burry's analysis proved correct. His fund delivered one of the greatest trades in history, and the world learned a lesson it's still struggling to absorb. And today, markets are once again filled with optimism, anxiety, bubbles, and bargains, depending on who you ask. Michael Burry has new warnings. Investors are hunting for the next big trend, and the financial world is shifting faster than ever. In this episode, we're breaking down the state of the market, the signals worth paying attention to, and what some of the sharpest and loudest voices think comes next. Welcome to Plan to Prosper, where we exist to honor God by equipping faithful servants to steward their finances wisely and build wealth that endures for generations. Welcome to another episode of Plan to Prosper, where I'm about to prove why I need a co-host. This is Thanksgiving week, and so Dalton and I were unable to be together this week. I am spending the week in Massachusetts at my sister-in-law and brother-in-law's house, and Dalton, I believe, is in Florida with his in-laws all week. So we couldn't get together, couldn't use the same studio we use. I'm sorry for the bad picture of Bill Cowher in the background. I am not a Steelers fan. I am a Birds fan, unfortunately, after this week, and anything else that might be in my background. But yeah, you're going to deal with me today. Again, I'm going to prove why I need a co-host and or guests. But hopefully you'll bear with me. So as I discussed in the cold open, there have just been a lot of things going on in the markets lately. One of the more Michael Burry is somebody that's paid more attention to just because of what he did during the financial crisis, and so I'll get into a little bit of what he's said of late and just kind of give a quick rundown of the markets. And kind of first, thoughts on why. Why do we pay attention to the markets? Why do we believe that there should be some level of knowledge about the markets? And it's because we believe that as Christians, as we discuss, as we open each podcast with, part of our mission is to help people steward their finances wisely, and we think that part of stewarding finances wisely includes stewarding their investments, and that you shouldn't just be kind of blind to what's going on. I'll kind of towards the end, I think I'll discuss kind of what all of the different current events mean for what all the current events mean for kind of what it means for the average investor, what they should do, things like that. But basically, important thing is that in order to steward, and sometimes I think you can delegate kind of to some degree delegate the stewardship to a financial advisor, to an investment advisor who's doing a lot of the investments for you. So that's why it's of the utmost importance for us to know what's going on and react as we can, but also help investors remain disciplined and objective, and kind of decrease the emotions. So I'm going to go through some of the things that are going on, not to necessarily cause anybody to take action, but just because we do think it's important to know what is going on. and on kind of both sides, kind of either give people uh, a knowledge of what's going on, and just so that they kind of know what we're looking at and anything that we might be doing, but also on the other end to potentially decrease emotions, anxiety, um, as some of the different um, people that get more airtime based on the markets say things that uh, might invoke anxiety. Um, so quick follow up on, I think now an episode we did two two weeks ago, on Bitcoin in particular, but just the crypto market. Over the last month, it hasn't been the greatest time for the crypto markets. As of data that I was looking at earlier, Bitcoin's down about almost 19.5%. I think it was 19.48% when I looked at it, but crypto does trade kind of continually, so that's going to be different depending on when I look at it. XRP is or yeah, XRP is down 16.38% over 1 month, and Ethereum is down 23.83%. So in kind of recent history, a lot of people have seen the run up in crypto. That can change. Over the last month, that has changed. We have seen some anxiety in clients because of that. And so kind of the important thing there is just that there are going to be waves. As we discussed 2 episodes ago, I'm not the biggest fan of crypto for a variety of reasons. You can go back and take a look at that episode. But overall, I just think it's hard to value. A lot of my training was in uh, the ways to value investments, and you can just kind of watch movements in crypto. Uh, I'm not convinced that there's a compelling way to actually value it and decide whether or not it's a good investment. Um, and but that being said, there are some reasons for the fall in crypto. There within the last, I think it's been the last 1 or 2 years, uh, different companies have created ETFs that are tied to the spot prices of certain cryptocurrencies. I know there's a Bitcoin, there's an XRP that actually I just found that out. Thought that was surprising. There's also Ethereum. I'm sure there are others out there, but uh, as of a week ago, so today's November 29th. As of a week ago, so I think it was the 21st. There had been large outflows in those ETFs during the month of November. The number that I saw was $3.8 billion in outflows. Um, it's and that was, again, that was as of a week ago. I'm sure it's uh, varied since. I actually think this past week there were probably, just based on the slight comeback in crypto over the past week, I'm sure that there were probably additional inflows. But again, that dollar amount is what I saw as of a week ago. We have been seeing this kind of increased correlation with risk assets. So in times where investors are thinking kind of more risk off, or just less willing to take risk, assets like crypto are potentially going to take a hit, as we have seen that increased correlation with risk assets. And then similarly, very similarly, it does kind of throughout the month of November, when looking at the variety of risk assets, things like equities. Um, it seems like investors, because of different events going on in the markets, are dialing back on risk a little bit. So things like Bitcoin, XRP, and Ethereum would be included in that. Um, so yeah, we have, not to rub it in Sam's face, who was on that episode with us, but as of now, I think I'm winning that debate objectively. I'm just gonna rub it in Sam's face there a little bit, go completely against what I just said, and actually rub it in Sam's face. But yeah. So then I had discussed in that I had kind of gone over the story in the cold open of Michael Burry. Um, I think most people would be most familiar with Michael Burry based on the movie The Big Short. Um, Actually, a book first. That is a movie that I've seen, and I have not read the book. Shame on me. I do like reading books before watching movies. It was, I think, one of the ways to get my wife more interested in finance. Not that she's been that interested, but she did watch The Big Short with me, um, and it was funny. She and I were talking about this. I don't know. Occasionally, she'll ask me about things that are going on. It's not typical that we talk about financial markets and the news related to that and everything, but we were talking about them the other day, and I was talking about something, or I had mentioned Michael Burry, and she didn't know who that was, or didn't remember who that was, and mentioned The Big Short, and uh, talked about kind of the way that the movie portrayed it. She was under the impression that Michael Burry like created that short position, and then immediately the markets took a dive. That's not how it happened. He was actually like almost 3 years early, 2.5 to 3 years early on when he um, decided to take a short position um, in the markets and just specifically mortgage-backed securities. Um, and so just kind of an interesting difference in the portrayal of the movie, and it's a movie compared to what actually went on. I mean, based on he ran a hedge fund, so there's less transparency there. But based on everything I've ever read, even though he was early, he knocked it out of the park in terms of performance over the. I think his hedge fund was open from like 2000 to 2008 back then. Um, he so he's now making waves because he had another fund that he just recently, I think it was beginning of November, maybe end of October. I can't remember the exact date, but he decided to close, kind of liquidate all the assets and um, close the fund. It was right around the time that he really started speculating that AI is in a bubble. Um, and there are a couple different reasons. He thinks that, in his opinion, there is some questionable. Uh, some of the AI companies have been participating in some questionable accounting practices. Again, according to him, he thinks that the uh, depreciation is being extended a bit too long, and therefore it's making earnings look much better than they actually are. He also thinks that there's too much capital expenditure by these AI companies, that there's no way that there's going to be as high a return on investment ROI as um, kind of these capital expenditures would lead investors to believe. And in general, he just thinks it's becoming too speculative. Um, and then there are counterpoints for why the alternative position, why he could be wrong. AI hardware may actually last longer, is something that I've read. Um, that while like the computer I'm on, uh, I think the last computer I used, I replaced it after 4 years, I believe. Um, that AI hardware may actually last longer. It just might be better hardware. So that could lead to good reason for a slower depreciation schedule for the AI hardware. Another another thing that some people pointed out is that these tech companies with very high capex spending, um, if you look at the bond market, which is another way to see what's going on in the markets, where there is perceived risk, um, these tech companies have bonds. So for people that are uh, less knowledgeable about investing, there's equity in a company, so you actually own some of the company. If you own a share of, let's just say, so one of those AI companies is like Microsoft, who has some ownership in OpenAI, ChatGPT. So you have tech companies like that. where if you own a share of Microsoft, you're actually a partial owner of Microsoft. Microsoft also issues bonds where you're not, if you buy one of their bonds, you're not an owner, but you are, they do have to pay you back with interest. You are lending them money and they have to pay you back plus interest. So some of the ways where, or one of the ways in which you can look at perceived risk in the market is comparing bond spreads. What that means is right now, T-bills, you can still get kind of short dated treasury bills at 4-ish%. I think last week when I was buying it was the high three nines, right around 4%. Um, and then you can look at what the kind of the typical investment grade bond goes for above that. So um, I think I most recently looked in the triple B, so kind of the lowest investment grade bond. So they're credit rating agencies that rate, hey, this company isn't as credit worthy as other companies. So and they create this whole scale. Triple Bs are kind of the lowest, and while still being considered kind of more safe than some of the higher yielding junk type bonds. And so the difference between what you can get in an average interest rate for a triple B bond compared to a US Treasury bill, typically considered kind of the risk-free type rate, is about 0.95%. So if um, Treasury bills are going for 4, that kind of triple B investment grade would be going for just under 5%. That's essentially what that means. So if you look at the actual tech companies like Microsoft, like Apple, um, Amazon, Facebook, Meta, now called Meta, um, those kind of companies, those big tech companies, Broadcom, Nvidia. If you look at those big tech companies, their spreads, so that 0.95% for the triple B, those big tech companies have very similar spreads. So if there was a much higher perceived risk by the market, by the market, the overall market in general, by the aggregate of investors, it would be likely that investors would require those big tech companies pay a higher interest rate because of the additional perceived risk. Right now, we're not seeing that. So that provides some case for why Michael Burry might be wrong. The other reason is that margins are still looking relatively healthy above depreciation. So kind of gross margins before you even factor in depreciation still look healthy overall, kind of in the aggregate. Uh, well, in the aggregate of the big tech space. So if Burry's argument is essentially these big tech companies are hiding or creating fake earnings by slowing their depreciation down. If that were if they were kind of hiding things, you would probably see uh, yeah, kind of the counterpoint to Burry is if these big tech companies were hiding things within their or based on their accounting practices, you would probably see other margins starting to falter as well. Right now, we haven't seen kind of falters above the depreciation line item falter too much. Um, yeah, so and just because it's interesting, I based on watching individual investors and what they pay attention to, kind of gives me insight on or watching some individual investors and what they pay attention to gives me insight on what a lot of people might perceive as important things to look into. So again, Michael Burry was one of those. He was right, arguably too early. What was that, 15 years ago now? Getting close to 20 years ago now. Well, actually, when he took action, it was almost exactly 20 years ago. He just because he was right back in the mid 2000s doesn't mean he's always going to be right. He could be right again. It doesn't mean he's not going to be right. In that AI might be in a bubble, but it also it doesn't automatically mean he's going to be right. So um, again, it's interesting that this investor who was right about uh, who's relatively correct again, maybe arguably took action too early. Performance still looked great though, based on what I've seen. Um, just because he was partially, potentially correct back then doesn't mean he's correct now. You can make an argument on both sides um, that AI does deserve increase in investment because of the potential there. But at what point does it become too speculative? That's two sides of something to look at, and things we're certainly looking at. Um, it's interesting. 2024 was wasn't the easiest year for anybody who wasn't just kind of an index investor because those big tech companies just took off, and so it's something we're always looking at. Um, I think there's also a good argument to be made that the um, producers of AI technology have been the main beneficiaries of investment performance. And I think that we will start, and we already to some degree have started to see the consumers of AI benefit from AI, just because they can be more efficient. They potentially don't need as high a headcount as maybe they thought before AI became kind of a reality. So there are different ways, different things that you can look at um, in which AI could benefit, or Michael Burry maybe right. It's we only time will tell, and kind of also um, provides kind of the backing for diversification. Any client that we work with isn't 100%. 100% of the portfolio isn't exposed to just kind of the AI taking off. Um, there are different ways in which you can diversify across asset classes or across a single asset class. And so, kind of one of the recent moves that we made is because of interest rates. Is we got into a financials position, more of or we've been trying to increase financial exposure in portfolios because there's an argument to be made that as interest rates fall, banks can potentially make more profit off of, or because they can borrow money for cheaper. Banks can borrow money for cheaper and then loan it out, and kind of the spread there can widen more than when rates are higher. Um, so again, you can diversify across asset classes. So I'm in equities, fixed income, and alternatives, but you can also diversify with asset classes. So I'm in equity, but you know whatever percent, X percent, call it 15% is in tech, 10% is in financials, 8% is in consumer discretionary. I'm making up numbers, but that's just how you can diversify as well to potentially protect against a bubble in one sector. So what else is going on there, especially this week, Thanksgiving week, which has been is traditionally a more thinly traded week, but there has been decent the talk of rate cuts has seemingly increased. Um, there was more. I think there was more of a question a week ago, a week ago today than there is now about whether or not December will bring an additional rate cut before the end of the year. And so there were kind of the dovish comments by the Fed. There have been mixed economic results. And so why kind of again over this last week was a decent week in the markets. Why is that a tailwind? Why is that a support for equity markets? It reduces borrowing costs. So if rates are lower, um, companies can borrow for cheaper. They don't have to pay as much as an interest. They don't have to pay as much interest. And so that will potentially help with earnings, and potentially help with innovations they may not have been able to afford otherwise. Just one reason. That there's also the fact that a lot of investors, when deciding on good companies to invest in, do something called DCF, discounted cash flow analysis, and part of that equation uses the discount rate. And typically, when rates fall, that discount rate falls, and when you part of the equation is dividing by the discount rate. So when you're dividing by a smaller interest rate, the perceived value of the company actually increases. And so if that happens, you're potentially going to see more inflows. Um, as investors need yield, they are going to look for places that provide more yield. For the last couple of years, they've been able to get, 4 to 5.5% interest rates on the perceived risk-free investment, which is U.S. Treasuries. As that falls, if investors need that type of income, they're going to look elsewhere. So they're potentially going to look at dividend-paying stocks, or they're going to just kind of work to the total return portfolio strategy, and but in doing that, allocate a higher portion to stocks because they need a higher total return than they'll otherwise get being in the treasuries. Um, Rate cuts also reduce what consumers need to spend on debt. So if you have a 6% mortgage and rates continually fall, and then you can refinance to a 4% mortgage, whatever that turns out to be in your monthly payment, all of a sudden you have additional cash flow that you can save or spend on other things. And then finally, and kind of related to that, I think there's a sentiment tailwind. So if you think, oh, I'm paying 4% on my mortgage as compared to 6%, it just provides a more positive sentiment for the market in general. So kind of overall, that's why the perception uh, of the rate cut coming has been a positive for the equity markets. And then over the past few weeks, we've investors have kind of it's been more so probably week to 10 days. We've seen an increase in smaller and mid-sized companies as compared to large companies, or kind of very specifically the last week to 10 days. That can be a sign of one or two things. One of two things. It can either mean, all right, investors think this is a good environment, risk on. Let's get into the riskier assets because it'll mean good things. That can be one thing. Or the other thing is it can just be a bounce during more of a fear market, and a bounce that doesn't last, isn't sustained. So you could see a bounce that then. So again, is that helpful? I'm basically saying it could mean one of two things. Uh, Probably not the most helpful thing, but again, features the value of diversification. Overall, our feelings towards small and mid have been positive. With the run in these big tech companies, we do think that there's a good opportunity in small and mid. Um, this is not investment advice. This is just information that I'm providing you with in terms of how we've been managing our portfolios. Not investment advice to anybody in particular, but we have kind of our overall thought is that we think that there's an opportunity for potential opportunity in the small and mid cap stocks to relative to large cap, because they've been kind of beaten up by large cap over the last 18 months to 2 years. We think there is potential opportunity there. Another kind of big talking item issue that we've seen is valuations. I just took a look at the Russell 1000 index of the 1,000 largest companies in the U.S. stock market. Excuse me. And 8 of those equities have forward PE ratios, price to earnings ratios of over 200, which is massive. I'll give you a few examples. There's Tesla, there's Palantir, Cloudflare, Snowflake, Roku. I would say 4 out of 5 of those are kind of the what people typically think of as tech. Like that is exposure to tech. I would say Tesla is potentially the only one that is a bit more nuanced, different. They're selling cars as well. They're selling cars, but they're also doing a lot of innovation with the tech. And there's a lot going on in Tesla that's not just car related. So that's the one that's a little bit different. But equities with a forward PE over 200 is pretty massive. However, a lot of the earnings have been massive as well. A lot of these companies have continually beat their earnings estimate, and that's why price remains elevated, because they are continually kind of proving that their price should be there because they're delivering on the earnings side. So as long as that continues, the price might not be in a kind of a danger valuation zone. But if we see earnings start to falter, it's likely we'll see prices start to fall because price to earnings over 200 is typically not is not considered cheap or value or anything like that. I'm in this because I think it's going to continue growing. So if earnings don't continue to grow, it's likely there will be some kind of falter in some of those equities with just the massive PEs. And then there are things going on in the bond markets as well. We're seeing that yields are continually falling on the expectations of additional rate cuts. Again, I went over that a little bit in the past, or a couple minutes ago, but as you see, or as you've seen, 5.5% Treasury bills, we're now seeing, high threes. So continue to see those yields fall. Of late, the triple B risk premium. So again, that the amount of risk perceived in some of those investment grade corporate bonds has been increasing a little bit. So some perception of a higher risk in the kind of corporate environment as compared to a couple months ago. There has been a lot of new bond issuance by the big tech companies. So kind of will those companies be able to keep up with their debt? Again, it's going to depend on a lot of earnings. It's going to depend on just the ability to continually create these revenue generating things, goods and services, in order to pay that back. And then finally, there's been a lot of talk in the private credit space. Private credit is kind of more of an alternative type asset, and it's essentially it's where some of these companies are going when they don't feel like they can get traditional financing. They'll go to a private investment company that will provide them with the debt at a higher rate, which makes it a little bit more appealing to investors. We've seen rapid growth. I was listening to a podcast the other day I haven't verified this number, so take it for what it is, but I was listening to a podcast that said that there are now more private debt investment vehicles essentially in the US than there are McDonald's. So just massive growth in that space. There's lack of transparency relative to kind of the traditional type debt. There's more of a lack of liquidity. A lot of times we're seeing private debt vehicles being in some form of investment vehicle that lacks liquidity. So like an interval type fund where you can only get out quarterly and up to a certain percent of the fund, things like that. And there's also additional types of risk, like a lot of this debt is covenant light as compared to kind of the traditional debt. So covenant light, that just means that there are less restrictions on what the company can do while they are paying this debt back. So a lot of times there will be covenants that like will limit the additional type of debt that a company can issue, limit the types of kind of mergers and acquisitions that can happen, limit what can be done to equity holders, like paying out dividends prior to paying back debt, things like that. We're seeing lesser of that on this private debt, uh, private credit, private debt. It's a similar um, word. And then finally, I just wanted to go over a quick kind of uh, anecdotal story, but something that you can see a lot of in um, kind of speculative markets where everybody wants to find the next best investment. And we just kind of ran into somebody who, unfortunately, is uh, eh, probably in the process of being scammed. Um, Whenever somebody comes to you and says, I put in, call it thousands of dollars, with the essentially the promise of multi-million dollar return. 99.999% of the time, just beware. And in a speculative environment, you are gonna see a pickup in that because kind of it's almost like seems like it's like keeping up with the Joneses. So if your neighbor investor is talking about all these home runs that they're hitting in the markets, you want to keep up. And so to do that, you're gonna take more risk, and it's not always going to be the smartest kind of risk. Uh, so I mean, it kind of preaches the value of having a third party objective advisor, whether that is me or us at Stonecrop or somebody else. Just have that objective advisor that's um, going to test whether or not this is a good decision or just an emotional, I want to keep up, or I want to get rich quick scheme. Um, so yeah, just beware when people are almost are will always beware if there's any kind of promise or guarantee. We being a regulated financial investment company, no guarantees can be provided. So if you're being guaranteed almost anything, it's very likely it's not a there's not as much regulation. That company has not put itself under as much regulation if it's a company at all. Um, Again, just something to be aware of in this type of investing environment where it seems like everything is always up and to the right. Now we've seen a little bit of a pullback lately. It's not as much of an up and to the right environment as it was even a month ago. But in that up and to the right environment, just make sure that you're making good decisions about what to invest in. Make sure you know your investments. Make sure that your investments make sense. So again, we like to remain, or we feel it is our duty. Actually, I'm by saying we like to. It is our duty to keep up with what is happening in the markets, so that we can make smart decisions for the people who have entrusted us to be good stewards of their funds. Um, and so what does all of this mean? So few philosophies at Stonecroft. No matter what's happening, we believe investors need a strategic asset allocation. What that means is there's, for the um, season of life you're in, the goals you have, the amount of liquidity you need or don't need. We believe that people need a strategic asset allocation. So some percent in equities or stocks, some percent in bonds, some percent in alternative type assets. That's the strategic. There's not gonna be a whole lot of deviation there, no matter what we see in the markets. But then there are also at Stonecrop, part of our philosophy is as we see things in the markets, we're gonna make tactical shifts. One way that we do that is by shifting the beta. So essentially, beta is um, to simplify, potentially overly simplified, just how much of the market risk and return you're getting. So If your beta is over 1, that means that you're getting more of the market risk and return, potentially getting more of the market risk and return because beta can shift without you even meaning it for it to shift. Um, if beta is less than 1, that means you're going to get less of the potentially get less of the market risk and return. And so if we truly believe that things are looking bleak ahead, we will shift our portfolios to a beta of less than 1. If we think that we're in a really good environment, we will shift our beta to a beta greater than 1. Kind of our view right now is we're relatively neutral. We're at about a 1 beta. We'll also make tactical shifts into more opportunistic investments. I think we've talked about this before, but one of the investments that we got into was a uranium fund, which has had a decent pullback lately, but we didn't get in because we thought overnight it would be a massive success. We got in because um, the investment thesis was that with all of this AI and crypto that is very demanding of energy, there's going to be a need for innovation in the energy sector. Nuclear will be one of those beneficiaries because investors and companies want to remain relatively carbon neutral, and nuclear does that. And so uranium supports the nuclear energy industry. And so kind of mid to long term, our thesis was that uranium will likely be a good investment. It's played out this year up until the last month or so, where it's had a little bit of a pullback, but you could argue it jumped too high too fast as well. We're still holding the majority of clients of our clients are holding it at a gain. And actually, it was interesting. Even I'm doing this podcast on Saturday. It was interesting yesterday that data there was the futures markets halted yesterday, Friday, Black Friday, one of the more thinly traded days of the market because there was a data center, I think in Texas, that had a cooling issue. And so they had to halt the market so that this data center could be cooled. So we're looking at potential ways to benefit on that exposure. One of the ideas has been water. We haven't made any decisions there, haven't really gone too far down that path yet, but we're starting to look into it and consider just the amount of water that's going to be needed to cool these data centers while also providing just drinking water to everyday citizens. And then there are also shifts that we can make in hedged investments. So investments that provide some downside on in the case of a market downturn, kind of like what Michael Burry did in 2000 when he opened the position in like 2005 or six. So we don't invest blindly. We look at kind of all the different aspects of the markets and decide how to invest. We do think that you need to have a disciplined approach. But a couple of examples of that: 2020, there were more popular investments back then, probably, although I've read that they're still relatively popular, called structured notes that can provide kind of essentially of the different outcomes of the investment, the different types of outcomes of the investments when you get into them. You can get in some that will provide a cap on the market, but also provide with some downside protection. So things like that. So in 2020, we had for our clients, we had a structured note that was coming due. I believe I would have to go back and look at the exact terms, but I think it was coming due on April 1st. It was right around kind of the height of COVID. And so at that point, our thesis was that we've taken the majority of the downside of this COVID downturn in the markets. And so instead of getting into a more hedged investment, we decided to kind of unhedge that, put that hedged investment into an unhedged position because we looked around at where the market currently was and the market conditions and things that were going on and thought that was a smart move. So again, that was more of a tactical shift in the portfolio where we weren't shifting from clients from 2/3 in the stock market to 1/3 in the stock market. We were just shifting the type of investment being used in the stock portion of the portfolio. And then also in 2022, after all of the printing of money, we thought our kind of again our investment thesis was that there was a high likelihood of increased interest rates, and so we decreased the bond duration in the portfolio in order to lessen the potential blow of a rising interest rate environment. It ended up being a much quicker rising interest rate environment than most people anticipated, but that lower duration did help portfolios. So in saying all of this, we're not just kind of buy and hold and set and forget. We are making shifts as we see things. That's why we stay apprised on what's going on in the markets and all of that, and why we believe that it's important to, again, we want to be good stewards of money, so that we can help our clients achieve their goals and objectives, and do that relatively efficiently. We believe all investors, whether or not you're working with somebody like us, needs a disciplined approach to investing. You can't just kind of close your eyes and decide, oh, today's a good day, without taking kind of any consideration of what's actually going on before making that investment. I think I'm going to wrap it up here. Hopefully I didn't provide too good a case for why I always need a guest. Happy to say that Dalton will definitely be back next week. We'll be back in the studio we typically utilize for this podcast. Look a little bit more professional. But again, on this kind of shortened Thanksgiving week, just thought it was important to just kind of go over some of the things that were happening in the markets. And but yeah, in saying all of that, I hope everybody listening to this podcast had a very happy Thanksgiving, and just time to relax and spend time with family and all of that, and just had a very blessed time together. So in saying all of that, look forward to getting back at it next week. So God bless.
Investment advisory services offered through Stonecrop Wealth Advisors, LLC, a registered investment advisor with the U.S. Securities and Exchange Commission. This material is intended for informational purposes only.